Hi everyone, welcome back to our channel. Today we are diving into an exciting topic that's been highly requested by all of you. But before we get started, if you are new here, don't forget to hit that subscribe button and turn on notification so you never miss out on your latest content. Trust me, you won't want to miss what we have in store for you today. In today's lecture, we will discuss important terms used in accounting. Now we can discuss what is an asset. An asset is a resource with economic value that an individual, corporation or country owns or control with the expectation that it will provide a future benefit. Assets are reported on a company's balance sheet. They are classified as current asset, fixed asset, financial assets and intangible assets. They are bought or created to increase a firm's value or benefit the firm's operations. An asset can be thought of as something that in the future can generate cash flow, reduce expenses or improve sales, regardless of whether it's manufacturing equipment or a patent. An asset represents an economic resource owned or controlled by the example, a company. An economic resource is something that may be scarce and has the ability to produce economic benefit by generating cash inflows or decreasing cash outflows. Now we can discuss what is a liability. A liability is something a person or company owes, usually a sum of money. Liabilities are settled over time through the transfer of economic benefits, including money, goods, or services. Recorded on the right side of the balance sheet, liabilities include loans, account payables, mortgages, deferred revenues, bonds, warranties, and accrued expenses. Liabilities can be compared with assets. Liabilities refer to things that you owe or have borrowed. Assets are things that you owe or are owed. How liabilities work. In general, a liability is an obligation between one party and another, not yet completed or paid for. In the world of accounting, a financial liability is also an obligation, but is more defined by previous business transaction, events, sales, exchanges of assets or services, or anything that will provide economic benefit at a later date. Current liabilities are usually considered short-term, expected to be concluded in 12 months or less, and non-current liabilities are long-term, 12 months or greater. Now we can discuss what is an equity. Equity meaning. Equity is the amount of capital invested or owned by the owner of a company. The equity is evaluated by the difference between liabilities and assets recorded on the balance sheet of a company. The worthiness of equity is based on the present share price or a value regulated by the valuation professional in investors. The account is also known as owners, stockholders, or shareholder equity. Types of equity. Book value. In accounting, equity is listed in the book value and calculated by the financial statement recorded under the balance sheet equation. The equation used to withdraw book value is equity, assets, liabilities through the asset are the sum of the company's both non-current and non-current assets. Other detail incorporated in the main account. Assets are fixed assets, cash, inventory, account receivable, property, plant, intangible assets. Similar, the liabilities are sum up of current and non-current on the balance sheet. Other accounts are short-term debt, credit, deferred revenue, accounts payable, long-term debt, fixed financial commitment, and capital leases. Now we discuss what is market value. In finance, equity is indicated as market value, which might be significantly lower or higher than the book value. The difference is because the accounting statement is looking at the paid, while financial statement is looking ahead and a forecast what the financial status of a company be. What is the market value of equity? Now we discuss what is the market value of equity. The market value of equity is the total market value of all the outstanding stocks of a company. Here the outstanding stock share are the shares that are owned by the shareholder investor of a company. Equity refers to the assets of a company after the liabilities are paid. It is also known as market capitalization. There are some factors which affect market value of equity, which are as below: a number of market contenders, number second, availability of new information, circular factors, government interference. Now we discuss what is revenue. Revenue is the money generated from normal business operations, calculated as the average sales price times the number of units sold. It is the top line figure from which costs are subtracted to determine net income. Revenue is also known as sales on the income statement. Revenue is money brought into companies by its business activities. There are different ways to calculate revenue depending on the accounting method employed. Accrual accounting accrual accounting will include sales made on credit as revenue for goods or services delivered to the customer. Under certain rules, revenue is recognized even if payment has not been yet received. It is necessary to check the cash flow statement to assess how efficiently a company collects money owed. Cash accounting, on the other hand, will only count sales as revenue when payment is received. Cash paid to a company is known as a receipt. It is possible to have receipt without revenue. For example, if the customer paid in advance for a service not yet rendered or undelivered goods, this activity leads to be a receipt but not revenue. Revenue is known as the top line because it appears first on a company's income statement. Net income, also known as the bottom line, is revenue minus expense. There is a profit when revenue exceeds expenses. Types of revenue. A company's revenue may be subdivided according to the division they generate. For example, Toyota Motor Corporation may classify revenue across each type of vehicle. Alternatively, it can choose to group revenue by car type. A company may also distinguish revenue between tangible and intangible products, like, for example, Apple products include iPad, Apple Watch, and Apple TV. Alternatively, Apple may be interested in separately analyzing its Apple Music app, TV, or iCloud services. Revenue can be divided into operating revenue, sales from a company's core business, and non-operating revenue, which is delivered from secondary source. As these non-operating revenue sources are often unpredictable, if non-recurring, they can be referred to as one-line event or gains. For example, proceeds from the sale of an asset, a windfall from investment, or money avoided through allocation are non-operating revenue. Now we can discuss what is an expense. An expense is the cost of operations that a company incurs to generate revenue. It is simply defined as the cost one is required to spend on obtaining something. As the popular saying goes, it costs money to make money. Common expenses include payments to supplier, employees' wages, factory leases, and equipment depreciation. Business are allowed to write off tax deduction expenses on the income tax returns to lower their taxable income and thus their tax liability. However, the Internal Revenue Services IRS has strict rules on which expenses business are allowed to claim as a deduction. Now we can discuss what is the income statement. The income statement is one of company's core financial statement that shows their profit loss over a period of time. The profit or loss is determined by taking all revenues and separating all expenses from both operating and non-operating activities. The income statement is one of three statements used in both corporate finance, including financial modeling and accounting. The statement displays the company's revenue, cost, gross profit, selling and administrative expenses, other expenses and income, tax paid and net profit in a coherent and a logical manner. This statement is divided into time periods that logically follow the company's operations. The most common period or periodic division is monthly or internal reporting. For internal reporting, although certain companies may use a 13 period cycle, these period statements are aggregated into total values for quarterly and annual results. This statement is a great place to begin a financial model, as it required the least amount of information from the balance sheet and cash flow statement. Thus, in terms of information, the income statement is a predecessor to the other two core statements. Components of income statement. The income statement may have minor variation between different companies, as expenses and income will be dependent on the type of operations or of business. However, there are several generic line items that are commonly seen in any income statement. The most common income statement items include sales revenue. Sales revenue is the company's revenue from sales or services displayed at the very top of the statement. The value will be gross of the cost associated with creating the goods sold or in provided services. Some companies have multiple revenue streams that add to a total revenue line. Number second, CGS. CGS stands for cost of goods sold. It is a line item that aggregate the direct cost associated with selling products to generate revenue. These line items can also be called cost of sales if the company is a service business. Direct cost can include labor, part materials, and an allocation of other expense such as depreciation. Gross profit. Gross profit is calculated by separating cost of goods sold or cost of sales from sales revenue. Now we discuss marketing, advertising and promotion expenses. Most business have some expenses related to selling goods and services. Marketing, advertising and promotion expenses are often grouped together as they are similar expense are related to selling. Depreciation and amortization expense. Depreciation and amortization are non-cash expenses that are created by accountant to separate out the cost of capital assets such as property, plant and equipment. Operating income. Operating income represents what is earned from regular business operations. In other words, it is the profit before any non-operating income, non-operating expense, interest or taxes are separated from revenues. EBIT is a term commonly used in finance and stand for earning before interest and taxes. Interest expense. Actually, it is common for companies to separate out interest expense and interest income as a separate line item in the income statement. This is done in order to reconcile the difference between EBIT and EBT. Interest expense is determined by the debt schedule. Other expense. Business often have other expenses that are unique to their industry. Other expenses may include fulfillment, technology, research and development, stock-based compensations, impairment charges, gain losses on the sales of investment, foreign exchange impact, and many other expenses that are industry or company specific. EBT. EBT stands for earning before tax, also known as pre-tax income, and is found by separating interest expense from operating income. This is the final subtotal before arriving of net income. What are income taxes? Income taxes refer to the relevant taxes charged on pre-tax income. The total tax expense can consist of both current taxes and future taxes. Net income. Net income is calculated by deducting income taxes from pre-tax income. This is the amount that flows into retained earning on the balance sheet after deduction of any dividend. Now we discuss what is depreciation. And actually depreciation is an accounting practice used to separate the cost of tangible or physical asset over the useful life. Depreciation represents how much of the asset's value have been used up in any given time period. Companies depreciate assets for both tax and accounting purpose and have several different methods to choose from. Depreciation overview. Assets like machinery and equipment are expensive. Instead of realizing the entire cost of an asset in the year one, companies can use depreciation to separate out the cost and match depreciation expense to relate revenue in the same reporting period. This allows the companies to write off an asset value over a period of time. Companies take depreciation regularly so they can move their assets cost from their balance sheet to their income statement. When a company buys an asset, it records the transaction as a debit to increase an asset account on the balance sheet and a credit to reduce cash or increase accounts payable, which is also on the balance sheet. Neither journal entry affect the income statement. The revenues and expenses are reported. At the end of accounting period, an accountant books depreciate. Now we discuss what is cash flow statement. A cash flow statement tracks the inflow and outflow of cash, providing insight into a company's financial health and operational efficiency. The cash flow statement measures how well a company manages its cash position, meaning how well the company generates cash to pay its debts, obligations, and fund its operating expenses. As one of the three main financial statements, the CFS complements the balance sheet and the income statement. Now we discuss accrual accounting. Under this method, revenue is accounted for when it is earned. Unlike the cash method, the accrual method records revenue when a product or service is delivered to a customer with the expectation that money will be paid in the future. In other words, money is accounted for before it's received. Likewise, expenses for goods and services are recorded before any cash is paid out for them. Now we define what is GAP or what is GAP stand for. GAP stand for Generally Accepted Accounting Principle. It is a set of accounting standard principles and a procedure used by company to prepare and present their financial statement, ensuring consistency, comparability, and reliability. IFRS. IFRS stand for International Financial Reporting Standards. IFRS is a set of accounting standards delivered by the International Accounting Standard Board for the preparation and presentation of financial statements globally. It's enough for today. Thank you all for tuning in. Remember to like, share, and subscribe for more content like this. Don't forget to hit that notification bell so you never miss an upload. Until next time, stay happy and keep exploring. Bye for now.